Hey, welcome to today's video and thanks for joining me. Today we're going to be looking at 5 retirement planning myths. I think you're going to enjoy this. There's probably 505 planning myths, but we're only going to look at the first 5 of them. And these are going to be in a 5-part series, so one at a time, so we'll keep the video length as short as we can. So I'm going to share with you one retirement planning myth, and I'm going to share 2 examples of what we mean by this, how this planning myth works. So stick around so you can see the examples, okay? Now, if you're new to this channel, my name is David. I'm an active advisor working with individuals, families, and business owners right across Canada. I've been doing it for 22 years. I create financial plans for my clients. I invest their money. And I also do life insurance. And so I work with business owners, teach them how to take money out of companies without paying any income tax. Pretty busy life of planning, but I love what I do, and I think it comes across in my YouTube channel, so I hope you enjoy the videos. Now let's get into why you're here today. Let's talk about the first planning myth, and that is I only need to use an RRSP. Now some of you might say RRSPs are a scam, they don't work. I understand why. I've seen and heard the examples of how people have used RRSPs, just didn't work out for them for whatever reason I'm not going to get into now, but I believe for the right kind of people, they're the perfect tool for, putting money aside for retirement. Now, there are other income sources that you're likely to have in retirement, like a Canada pension plan, old age security. If you're working for an employer that has a group retirement plan, then it's likely you're going to have a pension, like a defined benefit pension plan or defined contribution plan. I would encourage you, if you're not using tax-free savings accounts now, to begin, at least consider looking at tax-free savings account. They actually form a very important piece of the puzzle in terms of your withdrawal strategy of your money at retirement that could save you thousands and thousands of dollars. So head on over to these videos here and that'll talk to you about tax-free savings account. You might be an investor that has a pool of cash that you've decided to try to buy some dividend producing income streams. That might be some of the retirement income you'll be using. And then with 15 years of low interest rates, maybe you're one of those persons that have decided to get into rental income and purchase some condos or townhouses or apartment buildings, and now you've got rental income. So you can see there's a number of different retirement income sources beyond RRSPs. And when you start to mix in your RRSP, which is a taxable source of income, your RRSP converts to a RIF and you get a taxable income stream, and you mix that in with all these other income streams, then it becomes a little bit problematic where you start paying more income tax, higher income tax. So that kind of leads me into the next part of this video, and that is understanding how your RRSP works and how you might be paying a lot of tax and leaving some money behind when you pass away. So let's have a look now. I'm going to dive into financial planning software to show you what you might be missing if all you did was ever invest in an RRSP. Okay, now here we're looking at planning software. I'm not sharing with you, different strategies on how to do an RRSP meltdown or a RIF meltdown or how to save money on your estate. We're just looking at an RRSP converting to a RIF and a minimum withdrawal. So what I want to pay attention to here is this column right here. You can see this person is retiring over here at age 65. And they have $800,000 in their RRSP. And they are going to just say, look, I'm retiring. This is the only income source. I only invested in an RRSP. I don't have a tax-free savings account. I don't have non-registered. I don't have a gift from my grandparents or my parents. This is just me and my RRSP. So I've got no choice. I've got to RIF this RRSP now. So the RIF at 65, basically your RRSP turns into a RIF and you start receiving an income source. You can have it paid monthly or annually, doesn't matter. But in this case, they're saying $36,000 comes out of your RIF that year, and the next year, 37, 38, 39. So your RIF income goes up in terms of the percentage that you have to take out each year that you get older. So as you're getting older, you're taking out more money. You have $36,000 coming out, then 37, 38, 39. So you see, this is a RIF minimum withdrawal strategy. So I'm going to scroll down out, and let's go to age 86. So we're hovering over this now. Age 86, that's the average age of death in Canada. And you can see that they have $535,000. So imagine you are age 86, God forbid, but you passed away at age 86, and you started off with 800,000 and now you still have 535,000, never even had the benefit of spending that money and enjoying your retirement because you just did a minimum withdrawal. That person passes away with $535,000, and if you are the last person, meaning your spouse has already passed away, that money is going to go as your terminal tax income. So you're going to actually put $535,000 in as how much you earned that year. Any guesses as to how much taxes you're going to pay on $535,000 income? Quite a bit of money, right? About half of that is going to be gone. That's not what you intended for your RIF, and that's why having only one source of retirement, like one income source, is detrimental, because here you're either going to have to make a decision to do an RRSP meltdown, so start melting it down, which I'm going to share in the two examples right now, or you're going to have to take an additional amount, so a higher withdrawal rate of your RIF, pay more taxes. I'm not going to get into that and whether you should or not, but it's clear that you could be leaving behind, in this example, $500,000 for Revenue Canada to soak up half of that. That's not what you wanted. So let's go back into some examples, two examples that I want to share with you, okay? The first one is an example of someone who is, you can see these income sources, they're all colored so you can understand how a full financial plan with other types of investment income. So that dark blue that goes along the bottom of the screen, that is your CPP and old age security. So you see this person's starting at age 65 and they're getting old age security right away. And at age 67, 68, and 69, they take a little bit of RRSP money to supplement their income, in addition to non-registered investment portfolios. So you say 65 to 71, that light green color is a non-registered portfolio. So they're using non-registered plus their old age security and just a tiny fraction of their RRSP. Then by age 70, we have now decided, okay, this person has deferred the decision to take CPP right away, and they chose to take it at age 70. So now if you look in the year of age 70, they have old age security as for income sources, old age security, a much higher CPP payout, and then non-registered income. So still not touching the full amount of their RRSPs. Then at age 72, remember we talked about that RIF part where you go from RRSP to RIF. Age 72, they start having to take money out of their RIF. And now three mandatory income streams are happening. And I want you to pay attention to that word mandatory. So if you've got rental income or other sources of income, you have no choice but to take this money now. Government makes you take your RIF money and your old age security and your CPP. And so you see 72, you've got that dark blue is old age security, that light shaded blue is CPP payment, and then the green, the darker green, is your RIF income. You can see that tracking all the way across, income going up each year because we're allowing it to go up with the cost of inflation. So by the time 86 comes around, I think 85 actually, you can see a very thin sliver of non-registered assets being used as well. And so we see that a little bit of the non-registered is being used to supplement their income until age 95, and you can see this person is living to 100 in fact. But you can see part of that that light shaded green area, that is the RIF balance coming down because the withdrawal rate now is super high. It's like 20%. It's a big withdrawal rate. Let's look at an entirely different withdrawal strategy for someone who is in early retirement. If this might, I hope this appeals to you because this is happening quite a bit. I see a lot of people in a position where they can retire early. In this case, they're retiring at 58 as opposed to the average age of about 62, 63 in Canada of a retirement age. So let's look at how they're going to be doing a withdrawal strategy. In this example, they are using some of their non-registered investment portfolio. That is that lemon color lines that you see there. Underneath that, you'll see the darker green. This is from 58 to 62. You see this darker green. That is an example of an RRSP meltdown. Now let's skip to age 65 because that's when other sources start to flow in here. 65, that darker blue is the old age security. The light blue is CPP. So now that's a good example of old age security, CPP starting to pay in. This particular person had a LIF income, so it's another source of pension income. And then on top of that, you've got the non-registered income. So they're using those income sources until about age 67, when they add in one more layer of income, and that is tax-free savings account withdrawals. And you can see that they're doing tax-free savings account withdrawals. That's that darker green area. From age 67 all the way out to age 79, they're just topping up their income to an amount that they want to have to spend more money in retirement. You'll notice age 72 is the first year they start receive that RRSP income. That's that lighter shaded green below the tax-free savings account. And you can see from age 72 all the way out to 98 in their life, they're using their RRSP income. It's going up. So an entirely different income and withdrawal strategy than the other example. That's why I wanted you to see that there is many different ways to receive your money in retirement. And that's why getting a financial plan is so important, because when you first start investing money and you're trying to figure out, okay, this is what everybody says we should do, and then all these things change. You change employers, you are going to have a LIRA, and that's going to turn into a LIF, and then you're going to start going to work with an employer that's going to give you another pension. You decide to do some real estate investing. All those things changed, and now you've got like a mixed bag of different income producing assets. Financial plan is deeply important to someone like you. That's why I encourage everybody to get a financial plan to help you organize your retirement in a way that's more tax efficient, get to use your money in a better way, and also achieve all those retirement planning goals. Well, I hope you enjoyed this video. I tried to get it done as fast as I could. Remember that we take care of your wealth management so you can take care of what's most important to you. I thoroughly enjoyed giving you this video. I look forward to seeing you in number 2 of the 5 retirement planning myths. Again, thanks for tuning in, and I look forward to seeing you in the next video. Take care.